Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got Fong and the guru, Eric Broad of Bowery Legal on to talk through all the legal considerations startups need to know at inception. They run through a bunch of the details, like what kinds of legal entities to create, how to set them up, all the major considerations. This is a very practical and tactical session. If you're in the early days of your company, this is a definite must listen. So I hope you enjoy it, and let's go. All right, welcome Fong and Eric. Fong, you want to kick us off here?
Yeah, so today we have Eric Broad, founder and CEO of Bowery Legal. And he's going to be here answering some legal questions for us because I get this all the time in the incubator. Most founders obviously don't have a legal background, so they don't know what they don't know in terms of what they need to kind of get set up and started running when they start their companies, and then also how to lay down the foundational groundwork for scaling their businesses and making sure that all of their legal bases are covered. So we're gonna have Eric Broad here to answer all of those questions for us.
And he's like the guru. Eric's
happy to be here. I've been told I'm the guru. I tell others that I'm the guru as well. So it fits.
But it sounds better when someone else says it.
Absolutely. Yeah. To have someone else sell you is way better than having to sell yourself.
All right, Fong. What's our first question for the guru?
So Eric, we get this question from a lot of founders when they're getting started. There's a lot of questions around the type of entity they should start. So, a lot of people have heard terms like LLC or C Corp or S Corp. How do you choose which one you should be starting based on your business or your business model?
Yeah, this is the first question we get asked with new founders who have a product or a service or an idea, and they're ready to package it into a company, and they're not quite sure what type of company they want to form. And a lot of times the conversation is turned back to them with some questions that we'll have for them, like what is the product or service that you are providing? How do you intend to scale your company? Do you intend to raise third-party capital? If so, are you looking to raise venture capital? Sometimes they don't know the answers to these questions, but we can talk through what each of these different steps will look like. And a lot of times, the longer-term vision for the company will dictate the entity type that they want to form. With Mark and you from Interplay, you work with a lot of tech companies. You work with a lot of companies that are probably either have raised venture capital or are looking to raise venture capital. The classic venture-backed company is a C Corp, and it's almost always still these days formed in Delaware. There's a couple different reasons for that. One of them is a tax reason from the venture fund side is they can only invest a very limited amount of money into LLCs. Otherwise, they're kind of punitive tax measures or tax bills that the funds get hit with, and or they don't get the exemptions that they are trying to achieve in the way that they raise their funds. So VCs will almost always, for that reason, want to invest in C Corps. Also, there's an underlying fiduciary duty kind of legal framework for C Corps that VC funds prefer that aren't necessarily present in LLCs. And finally, from a tax perspective, C Corps are intended to and certainly incentivized to reinvest a lot of their proceeds, to grow fast, to maybe sacrifice profits a little bit because C Corps are taxed on corporate profits at the end of every year. So to emphasize growth and revenue, but maybe not so much profit. Versus on the other side of the equation, LLCs a lot of times are more kind of profit generating companies. So the longer term vision of the company, where you expect the growth capital to come from, will oftentimes dictate that And yeah, I mean, that's the first question. We can dig a little bit more into, if you'd like to, the differences between the two. But that's kind of the initial way to start thinking about it.
Yeah, no, that makes a lot of sense. Thanks for that. So would it follow that if you were thinking you didn't want to raise venture capital, that you would go for an LLC, generally speaking?
Perhaps, yeah. I mean, the nice thing about an LLC for companies that are thinking they might be able to be profitable relatively quickly, or even, by the way, if they're not thinking that it might be a quick ride to profit, but that the way that they're going to make money from the company is by distributing out the profits once the company starts to generate profit. LLCs are set up very nicely from a tax perspective. LLCs are what we call pass-through entities from a tax perspective, which means the LLC doesn't pay corporate taxes on profits that it makes, and all of the profits and the losses of the entity pass through to the owners of that entity. So if you and I started a business together right now, and we owned it 50-50, and we each put in $100,000 into that business, and we went and we spent all of that money before we started to make profits, that company would have, a couple $100,000. Maybe we end up spending more, but let's just say a couple $100,000. Those losses then pass through to us, to our personal income taxes. And we actually get the benefit of those losses that will offset any gains that we have from income elsewhere. Once the company starts making profit, so let's say in year 2, the company makes $1 million of profit, the company is not going to pay the around 20% corporate tax on that profit that it would if it were a C Corp. Those taxes would then pass through to us. So it's as though you and I, 50-50 owners, we each made $500,000 from the company in that year. The company then often does what's called a tax distribution. It will pay us out the money that we have to pay in taxes so that we're not coming out of our pocket for money that we haven't seen. But the idea is that it's a very streamlined and a very tax efficient, because you don't have that second level of corporate profit tax, way to run a company. So law firms, accounting firms, marketing agencies, kind of classic service businesses that are cash driven businesses that are generating profits, oftentimes relatively soon after they form and pretty easily. Those businesses tend to almost always be LLCs. We'll talk about kind of S Corp designations in a second, because a lot of them might be taxed as an S Corp as well. And then your kind of classic tech behemoth that we all know, right? The public companies, the Metas and Googles and Apples of the world. Those companies were almost all set up as C Corps when they started, and are all C Corps still now, as you have to be when you're a public company. But the idea of those companies is, Facebook is a really good example. Meta is a really good example, right? They were growing users for the entire private life cycle of the company. If I recall correctly, they didn't turn a profit until after they went public, and that's why a lot of investors at their IPO weren't sure what's the case for this company, and they were grossly undervalued at that time. But they were focused on growth. Everything that they got was reinvested, and they raised millions, if not billions of dollars on their way to IPOing. That is kind of the classic C Corp: reinvest, grow, sacrifice profits, maybe in the sake of growth, for the sake of growth. And then sometimes there's companies that are in between, where it's not quite clear, right? I have a company that I think that I might be able to make it profitable at the start, but I also think that I have a product that can potentially scale, and I'm not quite sure where this is going to go. What should I do? And then you get into some other questions. This is where you might have a long conversation with me or another legal advisor. You might talk to some tax advisors, because it's not always obvious initially that if you make profit, you're an LLC, or if you're not going to and you're going to scale, you're a C Corp. There's nuance there. And one key point is, converting from an LLC to a C Corp is not a taxable event. You can do that pretty easily, and you can always kind of start off, generate profits, see how things go, and move to a C Corp. Converting from a C Corp to an LLC is a taxable event, and a lot of times that tax makes it not really stomachable people to want to do that. So if you end up as a C Corp, but you're generating profit and you're realizing I'm not really going to scale the way that I thought I was going to, and now I'm getting this tax hit every year on the profits, and then when we pay out our profits as dividends, sometimes companies just bite the bullet and convert to an LLC so they can pay the tax all at once and then not have to deal with it later. But this is one of these considerations where sometimes you'll start as an LLC and then pivot to a C Corp because of the uncertainty, and that gives you the optionality that the other way around doesn't quite.
I want to add in here, I think that for people who are new to this, I just want to take off the table the idea of trying to outsmart the legal structure game. If you come to this and you're new and you're thinking, well, I'm going to outsmart it and not do a C Corp, I'm going to do an LLC, I'm do something fancy. The thing to note is that the legislators know how these two structures are typically used, and they write policy around each of the two structures. So when they're trying to incentivize more high growth company behavior, they write stuff that will affect C Corps. And so if you want to benefit from the policies that are designed to stimulate your part of the market, you kind of want to be in the right legal structure. And so talk to your legal advisors for sure, but the rule of thumb here is kind of stay in the lane.
Yeah, exactly. One great example of the way that the legislators fit policy to a specific type of company that's meant to grow, ideally in a specific way, is QSBS tax treatment. If anyone who's invested in venture, anyone who's raised money for a venture-backed company has become familiar with QSBS, Qualified Small Business Stock Treatment, which essentially says if you get your shares from the company before it has $50 million in gross assets, and if it's in one of a number of qualifying industries, most tech companies qualify for, you can have significant tax savings. For founders, it's like up to $10 million in taxes on a sale of their equity if they hold it for 5 years. For investors, though, it's 10 times their basis. So an investor invests $10 million in a company, they could have the first 100 million or so tax-free if the company qualifies. And some of the things that the company can't do, they can't go back and repurchase a lot of equity and take the money that should be reinvested into the company in the eyes of the legislators and buy out former stockholders. If a founder is leaving, let's say, and they want to buy out a significant amount of equity, you will lose your QSBS treatment on a significant portion of the equity of that company if you do that. The reason for that is that legislators set up this policy to incentivize investment in small companies that intend to grow to very large companies. And that's the behavior they want to incentivize. And what they don't want is money going out to the people that are involved in the company in large amounts. They've decided they don't want to incentivize that, whether that's right or not. But all of these things are kind of set up just like subsidies across the tax code are set up to incentivize certain types of behavior. And not everything is a perfect fit. Not every company is a perfect fit for one or the other. And so you find that middle road.
That's great, Eric. Thank you so much. So then, once you establish what sort of legal entity you should choose, what's the next step? Is it, like incorporation, and how do you figure out where you should incorporate, what legal documents you need from that onset?
Yeah, it's a combination of everything that you just mentioned. It's usually at the same time as deciding the entity. It's where do we want to form the entity. Conventional wisdom for many years has been Delaware's the right place to form your corporate entity, whether it's an LLC or a corporation. There's a lot in the news recently about X and Tesla and other Elon Musk companies moving to Texas, and some other companies moving from Delaware to Nevada and other states. I would just caution early stage founders, especially first time founders, from following the lead just yet. The process of operations, the understanding that investors have of kind of Delaware law and all the reasons that led Delaware to become kind of corporate hub in the first place still exist. And I think especially for first time founders that might not have an investor network and are trying to figure out how to do this with as smooth a road as possible and not kind of make bumps for themselves, I would say still go with the Delaware playbook. If you are again, using law firm as an example, if you are a licensed business that needs to be formed in a specific state, we are a New York-based law firm. We have a New York license. The law firm is based in New York because we are a professional limited liability company. So there are reasons, right? Hospitals, doctors, licensing attached to state regulations, attached to a business that needs to be formed in the state. Otherwise, generally, I would say you stick with Delaware. And then after that, depending on the type of business, you would have a suite of documents that you would put together to make sure the business is formed and then set up properly. And forming the business is just one small step. For a corporation, you form a certificate of incorporation in Delaware. For an LLC, you file, a certificate of formation. Two very simple filings where you could get a document from Delaware, fill out the PDF and file it, or you could come to us, and particularly for a corporation, we have a little bit better of a form that we would use for you. But that is just the very, very beginning. And then for a corporation, you need to make sure your board is properly established. All of the governance of the corporation is handled by the board of directors. The board of directors is elected by the shareholders of the company. So you need to make sure that your equity is properly granted out to stockholders. The stockholders properly appoint the board. There's board and stockholder resolutions that kind of say, we ratify all the things that have happened already so that we're properly formed and we're ready to go. Then there's other kind of ancillary things that shouldn't be seen as ancillary. They should be a key part of setting up any business, making sure that the intellectual property that you've already created, sometimes it's very little, sometimes it's actually a lot, right? Some software companies have already developed an MVP by the time they're ready to form. You need to make sure that is assigned to and owned by the company. That will be a big thing when investors diligence your company, and you don't want to ever have any potential joint ownership of IP issues, particularly if one of the founders leaves at a certain point without having assigned their IP. So that's kind of in a corporation: board consent, stockholder consent, establishing the board, issuing the equity, assigning the IP to the company. Those are the key things that you'll want to do. And there's other things you could do: establish an equity incentive plan, onboard employees, consultants, advisors, grant them equity if you've already working with service providers. For an LLC, there's a bunch of other kind of documents and considerations. The key document being an operating agreement. You'll also want to make sure you have your equity granted and your IP assigned. But there's a little bit more that goes into the initial economics and governance and formation of an LLC. Part of that is because you're not necessarily intending on bringing in venture capital investors who are going to define the terms of the governance for that entity. So it's a little bit more actually thoughtful of a process, which I think a lot of people don't really understand. Some people come to us and they say, "Oh, we're forming an LLC. It should be half as much time and effort as a corporation." It's actually the other way around.
Well, for anyone listening to this who's thinking, "Oh boy, I got to take notes on that," don't. This is why the gods created lawyers, so you can just call them up and tell them what you need, and they kind of figure all those things out that Eric just described.
Absolutely, yeah. The gods are good, as they say.
Well, Eric, thank you so much. Actually, I have one more question, because you made me think when you said that a lot of times people will come to you, they've already got their MVP. Like, when is a good time to do all of this, right? Like, I start with my co-founder, we start working on a project. Do we want to do all this before we do all the work, or is there like a milestone, like we want to get investment, or we're hiring our first employee? Like, what's a good time to do all this stuff?
Yeah, I mean, the tricky part is it does cost a little bit of money to set up a company. there are ways that you can do it that are very budget and resource efficient. The way that I tend to think about it is if there's ever a third party involved and you're starting to do real work, you're starting to do real building, that's when you should form a company. If I'm an individual founder and I go hire a contractor to develop some software for me, I should have a company and they're assigning that IP to the company. That's very important to protect what you are bringing someone else in to build. If I am forming a company with another person and we're maybe a little bit past the idea phase and we're actually starting to build and invest our resources, similarly, I want to know that what we're building is building value in a common entity and is not building value that is owned individually by me and also individually by that person. And then if that person leaves the next day, then I might have an issue where I form a company and then I go out and I try to raise money and there's someone else out there who also says, well, this is my idea. And either I'm going to build the same competing thing or I'm going to come after you for equity in the company later on down the road because you took my idea and turned it into a company without coming to a business arrangement with me. So whenever it goes out of the kind of individual building phase or that kind of initial idea phase, that's usually the right time to set up a business.
All right. That's super helpful. Thank you for giving us all those things to think about. That was super practical. I feel like a lot of our founders will find that that'll answer a lot of their initial questions about how to start a company.
Eric, before you jump here, Fong, before you jump, Fong, could we see your mug? What are you drinking out of here? What is this? Okay.
I forgot I had this, and then I took a sip.
That is not podcast appropriate, but amazing. Thank you.
Keep it
very,
in.
Very
keep it in.
much.
Will, don't cut this out. Keep this epilogue in here too.
I brought it to show every time you said something I disagreed with.
Yeah. You didn't drink out of it a lot. I noticed that. That's good.
Well, yeah, because Eric knows what he's talking about.
That's fine. All right. Thank you, everybody.
All right. Thank you.
All right. Special thanks to Fong and Eric for jumping in today to kind of lay this out. This is the kind of stuff that no one wants to think about, but everyone needs to. And so hopefully this was helpful to you in getting your company set up. And with that, we'll catch you next time.